All right, well, to speak to us more on this, we're now joined by Prescient Investment Management's Quantitative Analyst and Economist, Hannah de Nobrega. Hannah, thank you so much for your time. I mean, as you've heard in that clip, there is a strong sentiment, of course, that the Reserve Bank is expected to keep the repo rate unchanged. What are your projections?
Thank you for having me, Onati. So the market projections in general are actually pricing in interest rate cuts for this year at about 50 bips. At Prescient Investment Management, we consider it all. So while market projections are pricing in these cuts, we have to listen to what the Reserve Bank has communicated to us, and they have explicitly said that they will not cut interest rates until headline inflation has actually reached the midpoint target of 4.5%.
And it will be interesting to know and to see, I mean, how these developments impact on ordinary citizens. Can you unpack that for us? I mean, what does it mean then, you know, if the Reserve Bank keeps these rates then unchanged, particularly for indebted consumers, and on the one hand, for those that are actually saving and want to gain from interest?
So if we take a look at why the Reserve Bank wants to wait until inflation has actually reached the midpoint at 4.5%. This is because if we unpack inflation a little bit, we want to see things like food prices and our consumption goods. We want to see those prices come down to a stable level. So on that side of the coin, on the consumption side of the coin, consumers will actually be able to afford their everyday goods a lot more easily. Servicing debt costs will remain elevated for a few more months, but at a relatively low cost if you consider that price stability is one of the main targets and mandates of the Reserve Bank. So while consumers might have to stomach, and indebted consumers might have to stomach a prolonged period of high debt costs, it is actually for a larger benefit of the ease of living and consumption every day. On the other hand, with consumers that are invested and households that have people that are saving their money, at the moment we are seeing very high returns on the in money markets, so on the short end of the yield curve, where you can get close to 11-12% return on your savings and on your investments, and that's really fantastic. The key would be to position your investments now to be less short-term dated and look further into the medium term. So you want to hold a position that can lock in the returns that you're experiencing now for the medium term. So you want to really look at assets that are more on the belly end of the curve or the belly of the curve to lock in those returns, while the short run returns will come down a little bit when interest rates do start coming down as well.
And let's look at, those potential good news in the horizon. I mean, in terms of inflation trajectory, what are you forecasting? I mean, just listening also to the concerns on the growth prospects for this country.
Yes, so inflation trajectory actually, if we unpack that a little bit, we got fuel prices coming down nicely and as expected. We have food prices coming down. There's a slight uptick that we're expecting in household utilities of about 7% on average, and household utilities consists about 20% of your CPI basket. So inflation isn't, while it's drifting down slowly, it's not plummeting down, and that's why there's this like elongated waiting game for interest rates to start cutting. And then on the growth side, we expect, especially now with this newly formulated GNU, if the policies are remained stable, then we can expect a large amount of accountability and concentration to go into our electrical power and supply reform, and then also the supply chain reform, as well as the stronger exchange rate helping a lot with economic growth. So there is a growth forecast as well, which is very positive, as well with inflation coming down quite nicely.
Yeah, it is good to hear. I mean, there's a story that we're running here on the channel of the IMF. I mean, and I want you to unpack a little bit about what we are hearing. I mean, the International Monetary Fund, saying, just from a global perspective, saying that it expects global economic growth to come in at 3.2% this year. But for South Africa, it's keeping the growth outlook unchanged at 0.9% for the year. I mean, what can we read into it? I mean, this is despite, of course, we're seeing improved electricity supply situation in the country, but yet we are, hearing these sentiments. Your understanding of this, please.
Yes, so at Prescient, we understand that the risks to South African growth are quite balanced at the moment. So what we mean by balanced means that there are equal amount of upside risks as there are downside risks. So a positive shock to a reduction in load shedding isn't necessarily a sustained permanent shock. It goes the same direction as a negative shock to electricity and load shedding. So there's recently been a payout with the Jafeka account, which is an account that the Reserve Bank holds for the National Treasury. It's a exchange rate account, and that basically allows the rand to flow quite freely. I won't go into that right now. Yeah. But the payout has been distributed to National Treasury with the intention of addressing specifically the Transnet issues, which is a supply chain mandate for the country, and then also the load shedding. So that doesn't mean, because the payout has happened the other week, that doesn't necessarily mean that the policy is going to be in place fully, but there is a signal that hopefully we can improve on these structural growth changes going forward. It still remains to be unseen, so we still have to wait and see what's going to happen in order to actually project what the growth could be. And that's exactly why risks are balanced, and it would make sense to forecast growth as remaining unchanged, because both upside and downside cancel each other out.
Hannah, as we wrap our conversation, I want to veer a little bit to the political side of things very quickly. I mean, yes, tomorrow we are expecting President Cyril Ramaphosa to address the opening of Parliament, and he will then use this opportunity to outline and speak about the priorities of the 7th administration. We know there was concern going into the election about what this might all mean. What will you be closely watching in terms of that address by the President tomorrow?
So it's important to consider whether any new unexpected policy recommendations are brought forward by other parties of the GNU. If there are new policy suggestions, it might spook foreign investment. So hopefully we're going to look out for a very focused and a very well combined GNU that has general consensus of wanting to move forward with policies that are already in place, which are pro-growth and pro-cyclical, rather than outlier type policy recommendations that might spook foreign investments.
All right, Hannah, thank you so much for your time. That is, of course, Prescient Investment Management's quantitative analyst and economist, Hannah Nobrega. Thank you so much for that.